Hello, everyone. Adam Short here with Short Financial Group, and I'm here to give you a very special video update of the new tax law that has been recently enacted on July 4th called the One Big Beautiful Bill Act, or OBBBA for short. So this is one of the biggest pieces of tax reform legislation that we've seen in quite a few years. And so it will have a massive, broad-reaching impact to individuals and businesses beginning here in 2025. So I thought it would make sense to give you a special video overview along with a overview document here that I'll be kind of loosely following as I go through some of the key provisions of the new tax law. And hopefully for you, it will arm you with information to help plan before the end of year and beyond, because we still do have several months in 2025 to go ahead and plan for how we can maximize our benefits under the new tax law, both from a personal standpoint and, if you're a small business owner, from a business standpoint. So again, this is effective in a large part in 2025. So we're going to start with the personal / individual and family impact here. So you'll see I'm sharing my screen. This is a nice overview from the tax book, also known as Tax Materials Inc. So credit to them for this material. We'll provide this document as a PDF linked in the video so that you can refer to it. So let's start. I'll just kind of go through this and we'll walk through the different provisions. And so first we're going to start with tax rates. So as you may remember, back in 2017, we had tax reform that happened back then that changed our tax rates for tax years 2018 to 2025. So this new law, OBBBA, now makes these tax rates permanent that were set to expire at the end of 2025. So you'll see right here, you'll see this is for personal individual rates here. So we're basically continuing the same tax rates that we've had for about 7 years now. So you'll see here it's 10, 12, 22, 24, 32, 35, and 37% for individuals. And then you see also the estates and trusts tax rates as well. So this is good because if this legislation had not been enacted, we would be going back to a top income tax bracket of 39.6% for individuals. So this will help many taxpayers, even if you're not in the top brackets. It will help you stay in a lower bracket. So we think that this will help many taxpayers, most taxpayers, I think. So those are the tax rates. And then let's go to standard deduction. Standard deduction was increased right here. And so you'll see the different amounts for your filing status for 2025. So this is in effect for 2025 and forward. Now, after 2025, the standard deduction amount will be indexed for inflation. So that what that means is it will be increased by a certain amount each year beginning in 2026. But let me just point out that for many taxpayers, it will continue to make sense to take the standard deduction because it continues to increase. So for many of our taxpayers who file jointly, so married, MFJ means married filing jointly, or QSS is a less common filing status. That is qualified surviving spouse, but same standard deduction for them of $31,500. So this is a pretty substantial deduction. And what this does is it reduces your gross income to then arrive at taxable income, which is where your brackets kick in. So this is something to keep in mind as you plan for the end of the year and beyond for the standard deduction. Okay. Personal exemptions, I'm not going to spend much time on this. This is a lesser known, or some of our younger taxpayers may not remember this, but this was a concept that existed pre-2018 that was sort of put on pause. But then what we're doing now is we're actually permanently doing away with personal exemptions. It's not really going to be a big change or any change compared to what we've had in the past 7 years. But what this will change, though, is a brand new deduction for seniors. So, and this is specifically for tax years 2025 through 2028. So it will be available for seniors who are 65 years and older by December 31st of the year. So for 2025, if you are age 65 by 12/31/2025, then you may qualify for this senior deduction, which is $6,000 for each individual. Okay. So what this means is it's an additional deduction in addition to the standard deduction. So this is going to be helpful for our seniors. It can also be a planning opportunity for seniors who are trying to decide when to take Social Security benefits, okay? Because as you know, Social Security benefits are or can be taxed. Usually they are taxed for most of our taxpayers, okay? So that can be a strategic planning opportunity. Just remember that in order to qualify, you have to be age 65 before the close of the tax year. So meaning by 12/31 of 2025, if you want to take that deduction for 2025, this means when you file your 2025 tax return in 2026, you can take this deduction, okay? So, and then married filing joint as well. Here's the rule for the taxpayer's spouse. So same rule for that as well, reaching age 65 by the end of the year, or before the end of the year, that is. So there is a very important sort of filter, though, that this runs through. And so one thing to be aware of, if you are single, if your modified adjusted gross income exceeds $75,000, then that $6,000 deduction begins to reduce, and it phases, what we call a phase down. It's a decrease of that deduction as you go above the income threshold of $75,000 for a single filer or $150,000 for married filing jointly. So again, this is another planning opportunity. If you think that you might be bumping to those income thresholds, this could be an opportunity where we look at strategies to keep your income below that threshold so that you can still qualify for that deduction, that senior deduction. Okay. Let's move to the child tax credit for taxpayers who have children under age 17. The child tax credit beginning for 2025 has increased to $2,200 per qualifying child. Okay. The child has to be under age 17. And then after 2025, that $2,200 amount will increase. It will be indexed for inflation each year. Okay. So if you recall, the old amount for the child tax credit for 2024 and prior, although we did have some fluctuation during the COVID era, but it was $2,000 previously in 2024. So we've increased that to $200 per child. But again, the child has to be under the age of 17 by the end of the year, okay, by 12/31/25. And so if they turn 17 by 12/31/25, then they would not qualify. You would not be able to take the child tax credit for them in that case, okay? Let's go down to some business provisions here quickly with what we call qualified business income deduction. So this is a newer concept that's been around for about 7 years from previous tax reform that we've had in place now since 2018. But this was originally set to expire at the end of 2025, but now this provision has been made permanent, and we have new income phase outs that are applicable to qualify for this deduction. And again, this is for business owners, and even if you're an independent contractor, i.e. you receive a 1099 for income related to self-employment, meaning you're a contractor of varying kinds, whether it be Uber, Lyft, or even you're a consultant, or you do some type of work where you receive a 1099, or you may not even receive a 1099, but you are a self-employed business owner, then you even would qualify. You may qualify for the qualified business income deduction, which again, this has been in place for several years. So it's not a new concept. It's just that we're extending this and making it permanent now. Okay. And then I'll let you kind of read over the income phase outs here beginning in 2026. And then the other thing to mention is beginning for 2026, there's now going to be a qualified business income deduction is going to be the greater of $400 or the deduction that's calculated under the regular rules. I know that's kind of complicated, but it's kind of a nice, add, because it helps people potentially benefit for the deduction that may not have benefited previously. So just be aware of that. And again, this applies to, I mentioned self-employed people who are 1099 contractors. It also applies to partnership businesses, S-corp businesses. So these are the kind of businesses it does not apply to a C-corp. So the qualified business income deduction is not available to a C corporation. So just be aware of that. It can help, inform what type of business entity you form for your business. Okay. I'm going to fly through estate and gift tax exemption amount. This is applicable to less people, but that was increased to 15 million. And then alternative minimum tax phase outs and exemptions also were modified. That is for 2018 through 2025, made those provisions permanent. But I'll skip through that because that's not as pertinent for many people. Let me kind of hone in here on the home mortgage interest deduction, which is making permanent the extension that we had in the past 7 years. So what this means is, for home mortgage interest, for you to be able to deduct that mortgage interest, first of all, you have to itemize your deductions, right? And then you also are limited to your mortgage principal amount no more than $750,000, okay? And then if you have a mortgage balance that's over that, then there's a phase down of deductible mortgage interest. Now, this does say that home equity debt is considered non-deductible personal interest. That is generally true. However, if you use home equity debt to remodel, renovate, expand, or construct an add-on to your primary residence, then that can be deductible in those circumstances. So just know that there are special circumstances where home equity debt interest can still be deductible if you itemized your deductions and you meet all those criteria. Okay. Another new thing that came into place with this law is we are putting back into place the deductibility of mortgage insurance premiums. They were deductible for a period of time, but that went away after 2021. But this will come into place for tax years beginning after 2025. So it won't be available for 2025, but it will be available for 2026. Okay. There's a phase out right here of income. If you go above these income thresholds here, then you won't qualify for that deduction. Okay. Casualty loss deduction limitations. So this will allow for you for tax years 2026, basically, and forward, you may be able to deduct personal casualty losses if it's related to what's called a federally declared disaster area, or now a state declared disaster area. That's a new piece there, where a governor of a state can actually declare a disaster area and it can qualify for a federal income tax personal casualty loss deduction. So this lists the types of disasters that would qualify here and sort of the rules around that. So just be aware of that. If you've been in an area this actually would not apply to 2025. So we've had a lot of natural disasters over the past few years. Just hopefully nobody has any natural disasters anymore. But if you do in 2026 and forward, be aware of this for tax purposes. Okay. I'm going to skip the miscellaneous itemized deductions. That's less applicable. And also the itemized deductions tax benefit limitation. That's a very complicated formula that I'm just going to skip over that, but you feel free to read through that. Bicycle commuting, I'm going to skip that. That's not as pertinent. Moving expenses, not as pertinent. Gambling, not as pertinent. Feel free to look at those if they're interesting to you. There is now a change to the saver's credit, which this is this is an incentive. This is a tax credit that incentivizes taxpayers to save, to basically set money aside to save. So this is it's really an increase of the saver's credit from $2,000 to $2,100. Okay. Now, this next piece is very pertinent to a lot of people, and that is student loan debt discharged. So, or forgiven, basically, forgiven student loan debt. So now, beginning, if you have student loan debt, so your student loan is discharged or forgiven, okay? Forgiven is basically what that means. After 2025, so it has to be forgiven after 2025, there's now a new provision where you can exclude from income this amount if the forgiveness of the debt is because of death or total and permanent disability of the student. Okay, so there's some barriers you have to jump over, criteria you have to meet here, but this will help anybody who's in the death who unfortunately had experienced there's death or total permanent disability of the student. And then what that means is you get to exclude that from income and basically not pay tax on that forgiven debt, right? So normally you do have to pay tax on forgiven debt, but in this case you would not. Okay. Now, this next one is huge. It's called SALT, state and local tax. Now, you might have heard of this. Up until 2024, from 2018 through 2025, we had a limitation of $10,000 max for married taxpayers of SALT that you could deduct on your federal income tax return. But this has now been modified for 2025 through 2029. So right here are your amounts. And this is huge. This is huge, especially for taxpayers living in high state income tax states and property tax states. So places like New York, New Jersey, California, Massachusetts, and believe it or not, Texas and Florida. Even though Texas and Florida have no state income tax, they have high property tax. So it's possible that even taxpayers in those states could benefit from the increase to the SALT deduction. Okay, so for 2025, we've now increased it from, it was going to be $10,000 still, but now we're increasing it to $40,000. Again, this is for married filing jointly, right? If you're married filing separately, it's half of that amount, okay, down here. But this is a very, very pertinent area to plan for, and potentially you could even use a strategy called bunching, where you're basically you're timing your state and local property and income tax payments in the same year to be able to hit that threshold, to be able to itemize your deductions. So you do have to itemize to benefit from this. So all of your deductions have had to exceed the standard deduction for this to even matter. But if you're paying, $20,000, $10,000, $20,000, $30,000, even more in state and local tax, then that very well could push you over the itemized threshold and then help you here. So just be aware of that. Now, another huge area that has gotten a lot of attention is the deduction for qualified tips right here. And there's some misinformation going around. It's technically not no tax on tips. That's kind of misleading. It's more of it's really a deduction. And this is effective for tax years beginning after 2024 and before 2029. So really what that means is 2025, tax years 2025 through 2029, this is available. So it's not permanent. It would go away in 2030 unless Congress extends it. But basically you get to take a deduction for the qualified tips that you received during the year. But these tips have to be reported on a statement to the taxpayer, to you, the taxpayer, by the employer. Okay, so this would be either W-2, it should show up on your W-2, or Form 4137. So point being is, like, you can't take all this tip income as cash that's not reported on a W-2 and then go claim it as a deduction. You have to have it on the W-2. If you don't have it on the W-2, it will not be allowed. Full stop. So just be aware of that. Don't try to work around the system. You need to have it on the W-2. So, but the deduction amount is limited to $25,000. So if you go above the $25,000, you can't get any more deduction than that. And you do not have to itemize to claim this deduction. So that's super cool, which will help lots of people who normally would not itemize. For example, your servers in restaurants, even your Uber and Lyft drivers potentially. Now, you have to, these have to be qualified tips. They're not just any tips, okay? Qualified tips. They've got some guidance that's going to be coming out soon about what this actually means and the type of industries where qualified tips occur. So there's more guidance that's coming on this, but just know that there are some rules around what constitutes a tip, a qualified tip or not a qualified tip. So we should know more about this in the next few months as the IRS issues more guidance, okay? I'm going to skip the tip credit for beauty service businesses because that's a very narrow focused area there that's applicable to the beauty industry. But let me also highlight the qualified overtime pay, which is a new deduction as well. So it's not technically tax-free. It's technically a deduction. So again, there's been some misinformation going around about this. But this also, like the deduction for qualified tips, this is also a temporary provision that is in effect for 2025 through 2029, unless Congress extends that, okay? You are allowed to take a deduction equal to the qualified overtime compensation received during the year that's included on the statements furnished to the taxpayer. So in other words, it has to be on your W-2 for you to be able to take this deduction. And we don't know yet exactly how that will show up on the W-2. The W-2s we think will be revised by the IRS in order to be able to show what the actual qualified overtime pay was. But let's say you have time and a half, you were paid, your normal pay is $20 an hour, and then you worked overtime and you got paid $30 an hour. So the qualified overtime piece is the $10 additional. So it's actual amount that's over your regular pay there for overtime. So, and again, if you're a single filer, you get to take up to $12,500. And then if you're married filing jointly, you can take up to $25,000. Okay. And you do not have to itemize to take this deduction. So that's super cool there. And there is a phase out for the income range here where if you get above the $150,000 modified adjusted gross income for $150,000 for a single person or $300,000 for married filing jointly, then this deduction will begin to phase down and phase out. Okay. So that is a really great addition to the mix. There's another very interesting deduction that was created for qualified passenger vehicle loan interest. So again, this is a temporary provision. It will be for 2025 through 2029. Okay, so tax years beginning after 2024. So I know it's kind of confusing the way they word that, but it's 2025 through 2029. You get to take a deduction on interest for a vehicle auto loan, but this has to be a passenger vehicle, and it cannot be just any vehicle. It has to be a vehicle. Let me come down a little bit further. These are the rules right here. So the vehicle has to fit in these categories right here. So one of the important things is it has to have been, assembled right here. This last piece here is very important. An applicable passenger vehicle is a vehicle in which the final assembly occurs within the United States. Normally, with provisions like this, there's going to be a database or a search tool on irs.gov where you can actually look up your vehicle, type in there to know for sure if it qualifies, okay? And then, all right, so the deduction itself is available to taxpayers who have income under these thresholds or at or below these thresholds here. So $100,000 for a single filer and $200,000 for married filing jointly. So if you're above those, you won't qualify for this. there's some financial considerations to be aware of for this. It's one of those where, would it make sense to borrow more money just so you can have a greater tax deduction? Maybe not. So just be aware of that. The deduction is limited to $10,000 max each tax year. So that's the actual total max. Okay. I'm going to skip Trump accounts, but those are new accounts that you can read about here that are available. And then one of the big areas I want to highlight is related to businesses, and specifically bonus depreciation. So this is a huge, if you're a small business owner, this is a massive deal. So in previous years, we had 100% bonus depreciation, which means for certain equipment, vehicles, machinery, property that you buy with your business and put into service with your business, we could take 100% bonus depreciation in previous years, but that amount was phasing down. It was going to be 40% for 2025 under the previous law. So, but this has now been modified to reinstate the 100% bonus depreciation for 2025, okay? And it has to be specifically for property acquired after January 19th, 2025. So if it was before that window that you purchased, like in the early part of January, unfortunately would not qualify. So this will be a massive opportunity for business owners to be able to fully expense vehicles, equipment, machinery, and sometimes retrofitting of buildings like leasehold improvements can sometimes apply here. And you can go ahead and expense that 100% in the first year, even if you finance the cost. So that's a major deal that will help a lot of business owners. Okay. There's another big provision here for research or experimental expenditures. I'm going to kind of fly through that. I'm also going to fly through the employer credit for paid family and medical leave, but you can read through that if you'd like. And I'm going to fly through the business meals to employees. That's less common. Section 179 deduction is also very big for business owners. This is similar to bonus depreciation 100%, but it's a different type of expensing that we can use. And what happened is for 2025 and forward, Section 179 deduction limit was increased to $2.5 million. So that is the max deduction you could take for property placed into service in 2025. This amount will adjust upward each year for inflation after 2025. So it'll go up even more. The investment limit is $4 million. So just know that those numbers are way higher than they would have been had this law not passed. That's huge. Let me also speak to this. This next piece here is a brand new type of special depreciation allowance for qualified production property. This is for business owners. It's also known as 100% expensing of non-residential commercial real property. What this is, for example, if you have a business and you need to construct non-residential commercial real estate building property, think warehouse or store or some type of piece of real estate that is for the business, not residential, right? If you construct it and place it into service after July 4th, 2025, then, and if you meet all of these criteria, this is a brand new concept. You can expense 100% of that cost or your adjusted basis rather than depreciating it over 39 years. And under previous law, we had to depreciate and expense that a small amount every year for 39 years. This time, if you build the property and place it into service after 7/4/25, you literally can expense 100% of the cost, which is absolutely great. And then just know it has to be within the United States. It can't be some other country. So they're trying to incentivize construction and business here in the United States. So, and you can see some more sort of criteria here where they don't allow you to just build certain kinds of property. It has to meet specific rules around production of a product. And so just read through that. And if you have any questions, let us know. We'll help you walk through it. I'm going to fly through this employer provided child care credit and adoption credit. But I will highlight really quickly the dependent care assistance program. So this is if your employer provides dependent care assistance, they're excluded from the taxpayer's taxable income. So that means you as the employee get to not pay tax on that benefit because the employer provides it. That was already in place, but what they did is they increased the dollar amounts of excludable benefits, okay? So it's increased to $7,500 per year if you're married filing jointly, or $3,750 if you're married filing separately. So this is great if you have like an FSA account with your employer, and the employer basically you're allowed to pay for child care for your children, and your employer will pay that through your FSA account. Then you can exclude that and not pay tax on that money, basically is what that means. So very, very, very nice benefit. The child and dependent care credit, this is similar to what I just talked about, except it's for people who don't have, where the employer is not providing this benefit, but it's where you're paying out of pocket for child care. So you have to send your children to daycare while you and your spouse work. So this is an increase to that credit from the standpoint of the AGI, the adjusted gross income. So they did up that threshold there. The credit, though, itself is still the same amount as it was before. So it was $3,000 per child, or $6,000 for two or more qualifying persons or children. So that's still in place. Okay. All right. Educational assistance. So this is another employer benefit. So if your employer pays for education for you as the employee, you get to exclude up to $5,250 from taxable income. And this is a permanent extension of this provision. So we also get to exclude if your employer pays student loans on your behalf as the employee. That gets to be excluded from income, and you don't pay tax on that income for tax years beginning after 2026. So in 2027 and forward, the $5,250 amount is annually increased for inflation, so it'll go up some. Okay, let me highlight this additional charitable contribution. This is very, very key for individual taxpayers, so personal taxpayers. Okay, brand new concept where, and it will not be in effect for 2025, but it will be in effect for 2026. So we have to wait another year. But it's a brand new deduction where if you're single, you can deduct $1,000, or if you're married filing jointly, $2,000 of cash charitable contributions without even itemizing. So if you donate to your church or your other religious group or charitable nonprofits that are tax exempt, then even if you do not itemize and you take the standard deduction, you can take an additional charitable deduction. This is great. So, and the savings on that would be basically take your tax bracket and multiply it by how much you contribute up to the $2,000 married filing joint or $1,000 single. So that's not a bad deal, actually. And it's a nice incentive to donate and be generous. So the rest of this stuff is less applicable. It is applicable to some, but not most. So I will kind of skip those. But let me highlight this with the clean energy efficient credits. These are going away. Okay, so your clean vehicle, electric vehicle credits are going away. Those will go away after September 30th, 2025. So if you want to buy an electric vehicle and still get a tax credit for that, you need to buy it before then. Otherwise, you won't be able to get that credit anymore. And then also the other credits related to home improvement, energy efficient home improvement credits, and residential clean energy credits. These are like solar, things like that, and environmentally friendly heating and cooling, things like that. Those will go away. So just be aware. The residential ones will go away December 31st, 2025. Okay. So that's very important. If you plan to do any of that, do it before the end of the year. Otherwise, you won't get any tax credit. So, y'all, that wraps it up. That's a longer video than I expected, but hopefully y'all found this helpful. Again, this is an overview of the One Big Beautiful Bill Act that has been enacted, and we are going to be offering special tax planning for clients beginning probably towards the latter part of the year once we have more guidance from the IRS. So be looking for that. If you're looking for specific projections around how this is going to impact your tax picture, please let us know. We can put together a proposal for you to do tax planning and tax strategy and unpack this. So hopefully you found this helpful. Please do reach out to us if you have any questions, and we'll be happy to help walk you through it and make sense of it. And until then, take care. We'll talk soon. Bye-bye.